Hi class, I'm back with you now, and I want to do exercise 10-10 on page 469 from the Wild Book. Okay? This is one of the other key things I want you to learn. Okay? And this is dealing with loans. And this is not only for this chapter on long-term liabilities, but this is a life skill for you. Okay? So what we're going to do is we're going to learn to take that table that you just learned how to use, and we can actually figure out what payments would be. So like, you know, when you go to buy a car or buy a house, and you ask the people, okay, well, what's the interest rate? Well, what's the monthly payment? That's what we're all fascinated with, right? And over how many years will it be paid off? That's called an installment loan. An installment loan is when you pay an equal amount that has interest and principal in each payment. And by the time the life of the loan is over, you've got it written down to zero. And we are going to learn how to calculate that by thinking backwards about present value. And then we're going to learn to do an amortization table. Okay? And we'll make a journal entry. That's on 10-11. All right. So exercise 10-10 says that on January 1st, we borrow $100,000. Okay? And it's a 7% 4-year loan, and we make equal payments annually. So we're only going to make 4 payments. Okay? And we will start making those payments at the end of the year. Okay, on December 31st. Well, so what would the annual payment have to be that covers both the interest and the principal to get us down to nothing, to get it paid off in 4 years? Well, let's think backwards about this, okay? Use this, think about it like the loan is the present value. The loan is what it's worth now, okay? And what 4 payments can be made with a certain interest rate that are really worth $100,000 now with a 7% interest rate. Okay, well, let's just set up our table in reverse. Present value, $100,000. Let's just set this table up just like we did it a minute ago. Okay, the event is what we're trying to solve for. 4 annual payments of X. This is what we're trying to solve for across 4 years. 1, 2, 3, 4. And it's 7%. So get your table out, and look up the factor for 4 periods at 7%. Okay, the annuity. Use B, table B3. Use table B3 for annuity. And the factor is 3.3872. Okay, well, think about what we did when we valued our bond. We knew what the payments were, we knew what the cash flow was, and we found the factor and we solved for present value. This time we have present value, we have the factor, we solve for the payment. So 100,000 divided by 3.3872 works out to be an annual payment of $29,523. So that's what you're going to pay every year. Now we're going to make an amortization table, and I make my amortization table a little differently, a little different order than your author, but that's good because I want you to be flexible. You never know where you're going to go to work and how they're going to want you to do it. I set mine up with the total payment, the years down the side. How much of that payment is interest? How much of that payment is principal? And then what is the moving balance? So your balance is changing every time you make a payment. So we start out with $100,000 is the balance of the note at time 0, if you will. Okay? Now, when we make our first payment, which is exactly a year from now, we're going to pay $29,523, and we're going to pay $29,523 every year. And as you can see, that's a lot more than $100,000, and that's because it's got the interest built into it. Okay? The first year, after 1 year, we're paying 7%, 0.07 on $100,000. That's easy. I can do that without a calculator. $7,000. So this first year payment has $7,000 of interest in it, which means that out of this $29,523, $22,523 gets applied to principal. Okay? So the ending balance of the loan after we make this payment is $100,000 minus $22,523. Okay, so then the second year, this is what we owe. We're still paying 7% interest, but the balance isn't as high. So 7% interest on $77,477 works out to be $54,23. So see, our interest is reducing and more gets applied to principal each year. So that means that $24,100 gets applied to principal. So subtract $24,100 from $77,477, and we're down to $53,377 on this loan. Okay, then in year 3, we're only paying 7% interest on this balance. So that works out to be $37,36. So now, take $37,36 away from the total payment, and $25,787 is getting applied to the loan. Okay? So subtract $25,787, and we end up with a balance of $27,590. That's all we owe in the last year. Okay, well, what's the interest going to be in that last year? $27,590 times 7% works out to be $19.33, give or take a few cents. Okay, because of rounding. So $19.33 is the interest. If we subtract the interest from the total payment, then we're going to apply $27,590 to the loan, and the loan is paid off with the last payment. But we're paying $29,523 each time. Well, so here's what happened. When we got the loan, we would have debited cash for $100,000, and we would have credited notes payable for $100,000. And then in the first year, on December 31, we would have interest expense of $7,000, notes payable, I'm just pulling this right off the amortization table, notes payable of $22,523, and write a check for cash for the total payment, $29,523. Each year, I would make a journal entry recording interest expense, reducing note payable, and crediting cash for all 4 years. And if I was keeping a general ledger balance of my notes payable, okay, I would start out with that $100,000. I'd make that first payment. See where I debited notes payable? And then sure enough, I would have $77,477 left in the general ledger. Okay? I think you can do that.